In this class we're going to look at ratio analysis. The class will be concerned with the advantages and disadvantages of this approach. We'll look at various arguments for and against. So we'll start by let's have a look at two companies, Company A and Company B. And we're given two pieces of information about each, the capital invested and the profit. And we'll see that the profit is the same for both. Now, for some, that may suggest that both are equally efficient. But clearly, it's not the case when you consider the capital invested. Both companies make the same profit in the accounting period. However, Company B appears to be more efficient in its use of capital. This illustrates that we cannot simply take profits and make a judgment regarding the company's performance. We must link profits to some measure within the business. For example, the capital invested. It depends really on what we're doing and what we're talking about, but in this context, the capital invested is a good figure to take as a base. And from that, you can see that if we divide the profit by 1 million for Company A and divide the same profit by 10,000, then Company B will appear to be far more efficient, even though Company B is a much smaller company. So in order to make comparisons across companies and over time, we use ratios. That is, we divide one figure from the accounts by another figure, and this enables us to make comparisons between big and small companies. The accounting profession emphasizes 5 types of ratios, and in this class we will consider each in turn. It'll be a very brief discussion of each, but we'll have a look at them in turn. These ratios are profitability, liquidity, efficiency, gearing, and investment. Let's start by looking at profitability. As the name suggests, these express profits as a ratio of some other aspect of the business, such as assets or sales. So it may be the case that we take the profits of the business and divide it by the sales to see what the ratio looks like. And we could do that for different companies and compare the companies on the basis of that ratio, draw conclusions. So it gets rid of the size issue. That's the point. Big companies and small companies, it doesn't matter. And also companies over time. Even though circumstances change, we can look at and compare companies over time. Liquidity ratios. Liquidity means cash. A liquidity ratio measures the ease with which a company can meet its obligations. A company may have a lot of money tied up in fixed assets, in which case it may have a problem meeting its current liabilities, for example, paying wages. So if the company has a lot of property, for example, that may be not so good when it comes to paying wages at the end of or salaries at the end of the month. It needs to have liquidity. Alternatively, a company may have a lot of cash in the bank, so that it has no problems in meeting current liabilities. Next ratio was efficiency. These measure the productivity of the company in its use of resources. These are used to assess the proportion and use of borrowed money. These are the gearing ratios. So gearing is the proportion of the assets available which have been borrowed. So highly geared companies would be ones which have borrowed significantly. So it may be possible to compare companies according to how much they have borrowed, looking at their gearing ratios, so as to make a decision about whether they're good investments or not. Investment ratios, these measure the return on investment. That sounds quite straightforward. So it may be a case of just looking at the internal rate of return for each business and see what the internal rate of return on the investment is, or some sort of measure of return on investment. And these sort of ratios just tell us how efficient the business is in using its invested resources. Now, the use and pitfalls of ratio analysis. Well, accounting ratios enable the business person or investor to summarize and evaluate the performance of a business. So they're a very quick way of being able to measure a business. Once the ratios are in place, just simply compare the ratios. So it's a clever way of comparing businesses. They enable a comparison of performance over time and between firms. In fact, ratios may be used for a variety of purposes as follows. To summarize financial data, to assess performance and planning future strategy, and also as a tool for decision making. Ratios may suffer from drawbacks. Firms may value stock and depreciation differently, so comparisons may not be accurate. Depreciation in one company may be done on the basis of a straight line calculation. In another company it could be reducing balance. Stock could be valued as LIFO in one company and FIFO in another company. Last in, first out, or first in, first out. Or it could be an average of the last in, first out and the first in, first out. So depreciation and stock can be measured in different ways. And that means using ratios is not a meaningful exercise to compare the businesses. The different approaches means the ratios are not comparable. So therefore, different accounting practices may render the ratios useless. Ratios are calculated on published accounts and are therefore, to some extent, out of date. They're based on published accounts. The balance sheet is at a particular date, and ratios based on the balance sheet will be related to that particular date. It doesn't say how the business is doing right now. The balance sheet is a historic document. It's based in the past when the accounts were drawn up. So it is out of date. The ratios will be out of date because they are based on out of date information. So the ratios may not provide an accurate picture of the performance of the business. Comparisons over time are always difficult, and this is also true for ratios. So ratios may be affected by, for example, inflation or changes in taxation. Well, with inflation, prices are changing over time. So using comparisons over time, using the ratios to compare over time is not a useful exercise, simply because inflation has changed all of the accounts over that period. And the basis of the accounts, which is money, the value of money has changed over that period. Also, changes in taxation happen over time. Corporation tax, for example, or capital allowances. Also, there are changes in the exchange rate. The exchange rate is perhaps volatile. Perhaps it's a floating exchange rate, which means that companies that import or export a lot, who trade internationally, their profitability will be related perhaps to the exchange rate. And the use of ratios is not a proper indicator of their efficiency. Perhaps a better indicator of the efficiency would be the exchange rate itself. Also, changes in the interest rate outside of the control of the business. But it simply means a profitable business, or a business which is efficient and profitable, may suddenly look less healthy because the exchange rate or the interest rate or whatever has moved against it. Ratios may suffer from other drawbacks. For example, the ratio may reflect these changing environmental influences rather than the efficiency of management. So, ratios may be affected by seasonal factors, so the care must be taken to gain a true picture of the company's performance and not just the seasonal factors. In agriculture, for example, if the weather is particularly inclement or weather is bad in the growing season, profitability in the farming sector may be down, may be affected. And it makes farmers look like they are inefficient. In fact, it was outside of their control. So the use of ratios is not very useful. The example here is sales may be inflated at Christmas time, and a ratio based on this may portray a false picture of the company's performance. So just picking a particular time slot is not necessarily a good thing. It depends what's happening in that time slot. It could be bad, or it could be just a seasonal factor, such as Christmas. So ratios are sensitive and don't tell the whole story. For example, they don't tell us about programs of innovation within the business. It's just a ratio. It doesn't tell us what the business is doing or what the plans of the business are, which may be very important for investment purposes. It doesn't tell us about the R&D activity, the research and development that's going on in the background, the new products that the company is lining up, or their plans for the future. It doesn't also tell us about the morale of the labour force, whether labour relations are good or bad, or whether the workers are happy or deeply unhappy. It doesn't tell us about that. The state of any non-quantitative but important factors that go to make up any successful company. So it doesn't tell us about any of those factors. It's just a ratio. So what have we seen in this class? Well, we've seen what ratios are, how they could be used to make comparisons between big and small companies and companies over time. And then we've seen the drawbacks associated with using ratios. And there are many of those drawbacks that are important to note. So simply taking a ratio is not necessarily a good thing. We have to be more critical. What does the ratio mean? What's behind it? And what other factors should be taken into account? That concludes this video. So thank you for watching.